The S&P 500 witnessed a pronounced downturn yesterday, illustrating the market's volatility and the significant influence of external economic news and sector performances on the trajectory of the S&P 500. Reflecting on my analysis from January, it's becoming how evident the S&P 500 vulnerabilities are manifesting in the current market environment. Back then, I highlighted the vulnerable position of the market driven by an overwhelmingly bullish sentiment that, while propelling the market to new highs, also exposed it to a significant risk of a downturn. So, revisiting my January analysis, I was discussing the different signs of vulnerability underlying in the S&P 500. In January, I pointed out multiple different factors, including the observation regarding the investment landscape. In US equity futures, the market was heavily tilted towards long positions, creating a situation where a sudden market downturn could trigger widespread panic selling. This scenario of trapped buyers at the market's peak underscores the potential for a steep decline. Furthermore, in my analysis back in January, I did mention the volatility index current positioning. And what we should know about the positioning of VX is that if we take a look at this, the positioning of VX near this critical weekly support level historically has been associated with market tops, indicating an elevated risk for a downturn. As we could see, this level right here is highly correlated with market tops in the S&P 500. Not to mention market breadth and the Goldman Sachs breadth index. The market breadth is a vital indicator of the overall market movement's health, and this does signal concern for me. Despite the S&P 500 scaling new highs, what we should know is that rally had narrow leadership, with only a select group of stocks contributing significantly to the gains, highlighting that underlying market fragility. The Goldman Sachs Breadth Index position back in January was significantly low compared to the 30-year average, as we could see in this image. And this further emphasizes the market's vulnerable state despite its outward and supposed success hitting all of these new record highs. So as we observe the market today, the concerns outlined in January are increasingly relevant. The S&P 500's recent movements underscore the vulnerabilities I warned about, reinforcing the importance of cautious and being informed about the economic news sector performances. So, what happened yesterday? Yesterday, all sectors within the S&P 500 declined, with information technology leading the downturn with a 1.5% drop, with Nvidia leading the downturn with a 5% drop since yesterday. Other sectors, including healthcare, financials, communication services, materials, industrials, also experienced notable declines of over 1%. Interestingly, what I've found is that the energy sector saw the least amount of impact, with a relatively minor decrease of 0.3%. This sector-wide sell-off contributed to the broad market decline, with the S&P 500 falling by 2.2%. The Dow Jones Industrial Average fell by 3.7%, and the Nasdaq fell by 2.76%. So the S&P 500 plummeted by 2.2% in just 2 hours, reflecting a rapid reaction to broader economic forecasts and sentiment. In terms of market activity, there were more decliners than advancers, with 4,663 stocks falling compared to 2,419 stocks that managed to rise. As we could see this, there was a significant impact in the market yesterday. The total trading volume for shares yesterday approximately reached a 617 billion trading volume. And if we come back to here, you'll see that back in January, the fear and greed index, it was hitting greed, and we actually did hit extreme greed. So taking a look at CNN's fear and greed index, where's the barometer now? So it's at neutral, but Wall Street's fear gauge is on track to close at its highest level of 2024 after stocks moved violently lower. We quickly moved from greed and extreme greed all the way back to neutral. So a lot of investors see this as a potential great buying opportunity for the S&P 500 and for many other sectors. But the significant factor contributing to market sentiment was traders' expectation in the federal funds future market of an upcoming Federal Reserve interest rate cut in June. So essentially, what happened is that some Fed speakers were speaking yesterday. We had the president of the Fed talk yesterday, and essentially, the market priced in a 62.6 probability of a quarter percentage point reduction in interest rates. And this set that target range of interest rates at 5% to 5.25%. And this anticipation is in the backdrop of what investors have been awaiting. And as we could see, the S&P 500 actually did recently hit previous highs, pretty close to previous highs. So when the S&P 500 rebounded back again above the 5,300 mark, which was a strong level of previous resistance, as we could see, this 5,300 mark caused a, let's say, 1% downturn, whereas once we reclaimed above this level and dipped back below the 5,300 mark, recently we just had that 2.2% decline. So honestly, just by looking at the market through a technical analysis lens, this basic technical analysis helps us understand market complexities a lot more clearly. And as you could see, this drop is seen as a direct retest of the FOMC breakout right here. It's seen as a direct retest of this FOMC breakout that we experienced in March 20th. And as you can see, just by relying on simple yet effective technical analysis like supply and demand zones, support and resistance levels, using our charts, we could really see that the technical analysis was on our side the whole time. This was that FOMC rally. We're coming back into the same level of demand here at 5,200. So in conclusion, the S&P 500's recent movements reflect a confluence of sector downturns, economic expectations, and technical analysis. So while the market faced a considerable sell-off, moments of bullish recovery remind us that this may be a great investing opportunity. And what we should know is that essentially, in recent market patterns, we've seen the same pattern that we've seen for months on end. So if we come to this this chart right now, for months, if we go to a higher time frame, what have we noticed? Look at the market right now. Bulls have been defending swing lows. So this trend will continue to move the market higher, in my opinion, if we continue to buy dips back. So bears have been unable to sustain and hold any dip. And bulls are quickly buying pullbacks and putting in new highs. So the bulls right now are focused on capitalizing on this dip in the market and any dip. So as we near these lower levels, these are great buying opportunities since we have the clear pattern of buyers actively defending against price drops. So pullbacks in ES to previous support levels are likely to continue higher and offer us high quality opportunities for long positions until market conditions prove otherwise. So as we can see here, we're coming into our level of support and we're already quickly rebounding. So we could use this level of support here at 5,200 as a potential buying opportunity for swing long positions of previous highs, for day trades. And at the end of the day, my ideal entry for long positions would be back down here at 5202.75. So if we get a pullback and a retest into that level, that's exactly where I would personally want to go long. So, yep, that's my analysis of the S&P 500 today. I hope that you all found this very helpful. And if you are not already following me on Instagram, go ahead and hit me with a follow on Instagram. And if you want to learn more about how to analyze stocks and really dive deeper into the technical aspects and truly understanding the fundamental aspects as well, DM me for one-on-one mentorship at Damaris Trades on Instagram.